Welcome to Straddle Income. We're here to help you make money. In the last video, we talked a little bit about call options, how you can actually buy a call. And here today, we're going to talk about how you can actually be a seller on call options. And as you know more and more about trading options, you will soon find out that being a seller on option trading is one of the most consistently profitable ways of trading options. Let's don't worry too much about that. For now, let's focus on the basics. And before we jump into detailed content, I want to just make sure that you subscribe to our channels, and hopefully by the end, I can earn your like and subscription. What is the strategy we're talking about? Sell a call. So the way you can phrase that is you want to sell a call on SPY at 319, or you can simply say, I want to short a call on SPY at 319. The components in that statement is sell and short, basically indicating the option transaction type. The call is the options that we're talking about. SPY is the stock and the ETF, and 319 is the specific strike price. What this sentence really means is that as the seller, which is the provider of the option contract, I am obligated to sell 100 shares of SPY at $319 per share before or on the expiration date. So here are some keywords. I'm the provider. I am obligated. I am obligated to provide 100 shares at this price before or on the expiration date. This could be a little bit difficult to understand in the beginning. At least it was the case for me. So I always want to make sure I learn from examples. So let's go back to our favorite examples. Option contracts is similar to car insurance. And there's the driver, there's the car insurance company. And if the driver were involved in an accident, he would call the car insurance company to request for the payment for the repair costs. As the car insurance company, they are obligated to honor that agreement. Similarly, in this case, I am the option seller, so I am the insurance company, so I'm obligated to honor the agreement. And our agreement is to provide 100 shares of SPY at this price that we agreed upon. Let's talk about how you can actually set up the option sale in Thinkorswim. Here is the Thinkorswim platform. This is my paper trading account. As you can see, we're talking about SPY traded at 319.34 today. Here are the different option contracts with different expiration dates. You have June 15, expiration date, all the way to December 16, 2020 to expiration date. Let's pick something in July. How about July 6, 2020? So let's focus on the part where it's the option type is the cost. Let's don't worry about the puts for now. Let's go down and find the strike price that we're interested in. 319. You can see it's just way out of the blue range, and the blue range is the part where it's in the money. A quick way of explaining in the money is something that would help option buyer to have this bragging rights. 319 option, and if we want to be the seller, we just simply click the sell icon, and then we'll bring up this panel here. I'm talking about single spread, which is the sell. Let's do one option contract. SPY expiring at July 6, 2020. And the premium that we're receiving, as you can see, by providing the service and agreement, I'm getting the premium of $650. And in the case of the option, it's always one option equal to 100 shares. So really, I'm talking about $650. Let's look at the summary before we send it out. So here is how you read it. I am selling -1 SPY 100 shares weekly, July 6, 2020, and the specific strike price 319. This is the call we're talking about, and the premium I'm receiving by doing this transaction is 650, and the type is to open this contract. So we covered every single point here except this part right here. So I will focus on that in the video at the end. So let's talk about this, break it down. Selling a SPY contract, -1 indicates it's a sell strategy. +1 is a call strategy. 319 is a specific strike price we're talking about earlier. 650 is the premium that we're receiving. The break-even stock price is 325.50 cents. How do you get to that point? It's the combination of 319 plus the $650. Why is that? This is the underlying specific price, and the $650 is the premium that we're receiving. And the 319 and the 650 is the point where one party starts to make money, the other party starts to lose money. So break-even stock price. Max profit, $650. Max loss is infinity. This can be very scary to beginners, but think of swim is making sure everybody is aware of the risk. But in the case, this is very, very theoretical. This is going to be a little bit interesting and difficult to understand in the beginning. So I always try to think from the buyer side because that was the most logical way for me to think about option contracts. I hope I can use that for you, for your benefit as well. So in the option trading world, it's a zero-sum game, meaning some people make money, some people lose money. And I think about why buyer would have actually buys the contracts. The buyer buys the option to lock down a price. So if the buyer has this perception that the price of the SPY will go higher, but I don't have the capital, I wanted to make sure I can pay a certain dollar, 650, to lock down the price of 319. The buyer pays the premium, and the buyer is getting the specific agreed upon price. As a seller, I am obligated to provide this agreement. So for the buyer case, the buyer is profitable when it's above 319 plus 625. Remember, this is the price I pay. So that's when essentially sellers start to lose money. At this particular point, buyers start to make money if you look at it from buyer's risk graph profile. And for the seller, that's the point where the money is being provided to the buyer. So seller is losing money. Let's look at how you can actually set up this risk graph in the Singapore Swarm. Here is the transaction we were about to take action on. The way you can visualize the risk profile is to right-click, and there's the Analyze Trade. You click that. Let's remove the old one. Here's the risk profile, and you can use your mouse to scroll left and right, and will tell you what is this maximum profit and maximum loss. So as you can see, this part right here is 325.49. That's when I start to lose money if I'm the seller. Coming back to our investor mindset here. When I am the seller of a particular call strategy, my perception of the underlying is that I'm neutral, or at least I'm bearish about the ETF or the stock that I'm trading at. So I want to put a limit at a cap at 325. I hope it will never cross that point. Once it crosses that point, then I start to lose money. So my mindset is I'm a bearish or neutral about the underlying. However, later on we'll talk about something called a covered call, and that's a very, very popular strategy. It's actually a little bit bullish why you can turn around selling a call and make it bullish for you. Lastly, I want to come back to this concept. Remember, in the think of swing, we saw this thing called open and close. So in the option world, there's two different actions. You can buy and you can sell. And a contract has to be opened, and then a contract has to be closed. So two different things here. When I buy to open a contract, that's from the video previously, I have to sell to close. In today's video, we're talking about sell a contract to open. Then in order to lock down the profit, I have to buy to close. Let's look at a case study here. We were talking about SPY at 319. The short call and the received premium is $650. That's from our bid price. So essentially, we're sell a call and to open this contract at $650. So the buyer will come here and take it. Then if I want to lock down my profit, I want to get out the option contract. I don't want to honor my contract anymore with the buyer. I have to close it. And I close the call by buying it back at a certain price. Say, for example, here we're talking about $100. So this is the column from the ask price in the think of swing. So by doing those two paired transactions, I can have a net profit of $550. This is when I decide to buy to close, but if the options I decide to let it expire, I don't want to take a further action because I don't see a particular risk that somebody will exercise. I'll just let it expire. Then I can realize the full profit of $650. All right, so I think this is a lot for today. I want to make sure we have enough time to reflect and then summarize the things we talked about today. So today we talk about selling an option contract. We talk about the ways of starting that particular option contract by selling in the think of swing platform. We talk about the characteristic, limited profit, unlimited risk in theory, and the break-even point. We also talk about for options, what are the different actions involved? You have to buy to open, you have to sell to close. When you sell to open, you have to buy to close. Okay? So making sure you subscribe to our video. We'll talk about this in the future, and I hope this video is helpful for you, and I hope I can earn your like and subscription. Thank you.